everybody, we are back. Build a Profile Module 8. And in this module, we're going to talk about what are futures and how to trade them. As a reminder, every time we talk about risk of loss, especially as we talk about some of these products that are what we call levered product or leveraged products, risk is even more important. So pay attention to the risk that we describe in that, also the opportunity, but be mindful of whether or not the risk that's presented works for you. And if it fits your goals and your capital and your desire, we're trying to help you be as present of those as possible as we go forward. What's the module objective? Well, in this module, just like the last module, we talked about stocks, what they are, how to trade them. We're talking about futures and how to pick and trade them using profiling to find and qualify opportunities. I am so excited about this module because I love trading futures. It took me about 4 years of trading, 4 or 5 years of trading before I even had any idea what they were. And once I got exposed to what they were as a trading product, I really lost interest in just about anything else. So it's gonna be a lot of fun, hopefully expand the universe of what's possible or what you know by looking at this whole different product class. Lots of people know about stocks, not a lot of people know about futures. Futures are where the pros play. Okay, the concept. Through the use of leverage, a futures trader can accelerate gains relative to the capital outlay to establish a position. What do we mean by leverage? Well, imagine that you're going to go buy a vehicle. And the cost of a vehicle is about $20K, and a buyer hands over $2,000 in cash, and then $18,000 is borrowed from, either finance or somebody to get the vehicle. So the outlay of cash is only 10% of the vehicle's purchase price, using borrowed money to pay 90% of the rest. So this is what we call leverage. So the buyer is effectively levered 10 to 1 in terms of what the cash they put out to borrow. When we trade futures, we're trading a vehicle that allows us to initiate positions much bigger than the cash that we put out to establish a position. This is leverage. This is one of the great advantages of it. It's also why it can be a really risky instrument if you don't know what you're doing. So what are futures exactly? Well, they're a contract between two parties as a guarantee of future exchange. Futures have been around a long time, not quite as long as stocks, but have been around for quite some time. And they really existed as a way around commodities. So you think about grains, people in agriculture, people who mine, people who use oil and energy, these hard goods that have to exchange at a certain price. Somebody produces them, somebody refines them, and then they bring them to market. Well, one of the things about that is just an unknown is I have no idea as a producer of some product what the value of the thing that I produce is going to be 6 months from now. There's all kinds of market pressures, there's economics involved that could significantly impact that. But if I know that there's somebody out there that I'm going to sell to, maybe today I could enter an exchange with them around an agreed upon price that I will agree to sell that commodity to them at that price, and they will buy that commodity at that price. And the contract stipulates what's the term that the contract is good for, who's the buyer and seller, and how much quantity of product are we talking about. In some sense, it's a means of insurance. So imagine that you are a corn farmer and you have a price in terms of cost that's $2.75 a bushel. Picking out a number at random. Okay, but let's say that in March, the March futures contract is trading at $3.50. So $2.75 is my cost, $3.50 is what that's trading. I can sell that contract against my corn today and guarantee a profit margin, which in that sense becomes a form of insurance. So you find lots of producers of commodities who have futures contracts that are sold against their commodity to ensure that the open cash market can't radically affect the value of their product. They move in ticks, points, and handles. So different from stocks that move in terms of dollars and cents. Futures, because of the way that they're constructed, move in fixed increments called ticks. That's the minimum movement. So where in a stock you might have a minimum movement of a penny. In futures, a minimum movement is a tick. And each contract has different specifications on what that value is for that tick. If you put a number of those ticks together, you get something called a point. or a handle. So these are terms and jargon that you'll hear people in the industry use. They'll say, "Oh, well, I moved 5 handles today," and you'll go, "What in the world did that mean?" Or you'll say, "I got 60 ticks." Oh, okay, what does that mean? This is the nomenclature to get used to. Really, all you're talking about is the increment that product moves. So if it was stocks and dollars and cents, in futures you're talking ticks, points, and handles. Okay, so if they move in ticks, points, and handles, a position that you have on either appreciates or depreciates based on the perception of value and economic fundamentals. So these contracts ebb and flow in price over time as the market perspective of them being overvalued or undervalued and the number of participants changes. So if you are not a producer of a commodity, you are free to participate in futures markets. You're what we call a speculative trader, and you're adding additional liquidity to the market that gives the producer an opportunity to get better opportunities for their product. So it's actually adding value to the market as a form of middleman who adds additional liquidity to the market, which means there's additional participants, so that if a producer, say, of grain wants to be able to sell a contract, there's somebody that's willing to do that for them. Positions in futures are established through the use of margin and or leverage. So we talked about leverage here before, but to be able to establish a position in futures, you have to meet what's called a minimum margin requirement, which is a fraction of what you're actually controlling. And best way I can say that is like the example of if you're going to buy a car. So they'll let you buy the whole car and you're only putting a certain amount of cash out there. Now you're liable for the entire value of the car. So you're going to, if necessary or something happens to the car, you have to pony up the money eventually to cover that. Same thing's happening here, but they're allowing you to get it at a cheaper price to participate. So how do you profit or lose in futures? Well, a position is initiated by buying or selling a contract. So we talked a little bit about this in Module 7 around establishing a stock position. Most people know about establishing a stock position by buying a share, but you can sell a share to initiate a position. So you're starting as a seller, and to get out of the position, you buy it back. Or you can buy it, and to get out of a position, you sell it. So the buying and then selling, everybody gets. The short position, which is what we call so that's called a long if you buy it and sell it, is in that sequence. If you sell it and then buy it, you're called short. And so you can initiate a short position really easy in futures. And then how that position does is based on appreciation or depreciation on change in the contract price via ticks, points, and handles. So just to give a little bit of an example here, I am going to bring over, it's a product we're going to look at here in just a second. But this is a bid ask that we talked about when we were looking at one of the earlier modules. Here's the asks. The bid market is closed. There's a short window that futures are closed, but there's moving in ticks. So these quarter point, so 4 ticks make 1 point. But say, for example, that I bought at 27.47 and I go up to 24 or 27.48, I'm in profit, but by the number of ticks. And if I sold at 27.48 and then the market goes down to 27.47, I'm up 4 ticks. Commissions on futures trades are typically based per contract, not per trade. So different from stocks where you could buy 1,000 shares or 10,000 shares and pay 1 commission for that trade. Futures are always per contract. So if you buy 1 contract, you pay a commission. 2 contracts, you pay commission. 3 contracts, 3 times. Now, some would look at that and say, well, I'm paying a commission every time. That's more expensive, right? Actually, the commissions are pretty cheap. So relative to how the instrument works, there's a benefit in terms of the cost of the product, but they are based per contract. And then profit and loss is determined by the number of contracts times the position entry price plus or minus the current price. So, in some sense, similar to stocks in that way. Is it trading above where I got in, below where I got in? That tells me whether I'm in or not. Now, let's talk a little bit more about some of the benefits and risks. From the benefit side, we talked about leverage at the front end, which is a key benefit. the ability to trade much larger than the capital that you put out is a significant benefit of these products. You can control, for example, you can control about $70,000 worth of a product that you only put up about $2,300. So the ability to initiate a position on a smaller capital outlay means that you can profit much better. You can also lose at a greater rate. But if you know what you're doing, it provides an awesome opportunity and efficient use of capital. That's the leverage. From the another benefit is a product diversity. So futures are established as contracts against all kinds of products, and in stocks you're trading that basically that financial instrument against companies' value. So you're just looking at that's what we call an equity. It's an equity stake in a company. Futures allow you to express an opinion on all kinds of products. So you can express an opinion on the entire S&P 500. You can express an opinion on gold. You can express an opinion on the US dollar or the euro or soybeans or crude oil. There's all kinds of products and asset classes that you can express an opinion on that makes it a very attractive space. So if you want to really focus on currencies, you can focus on currency futures. If you want to focus on indices, you can trade index futures. If you want to trade just grains, you can focus on grains and agricultural futures. Really, really cool. It is, and another benefit is that it's the birthplace of profiling. So the whole idea of auction theory and profiling tools originated in the futures market. In the mid-'80s in Chicago, a guy named Peter Stottlemyre was observing behavior of futures traders in the trading pits and developed a graphical way of describing the behavior he was seeing. These were in futures markets because they were an open auction, and he was just graphically representing what was happening behaviorally. Now the benefit is they're very liquid, meaning that if I want to get in or get out, there's typically always a buyer or seller there that allows me to be able to make that happen. The worst thing you want to do is you be in a position and there's not enough participants on the other side to get you out. I've been in those positions before where I've been in illiquid markets and I've got a larger position than what's available. And what ends up happening, why that's a bad thing, is that you end up losing and paying up a lot of your position at different prices just to fill the order. So liquidity is a big deal. 24/6 markets. So different than equities, which have fixed sessions throughout the week from morning to evening and then they close. Futures trade 24/6. So they take a short break during the afternoon that closes and starts a new session, but then they'll trade overnight and they follow liquidity flow around the globe. So very, very great product. One of the benefits of a 24/6 market, not necessarily that you want to initiate trades at midnight, although you can, but it allows you to put orders in that can be working if something adverse happens in the market overnight. So, imagine that I'm in an Apple stock and overnight there's some really, really bad news that comes out about Apple, and say Apple's trading, let's just look at Apple here real quick, just to get a sense for where they're at. So they're trading 174.35. And let's imagine that tomorrow or overnight we get there's some huge news that comes out. Maybe Apple had defrauded a whole bunch of people and the market just going to punish their stock. Okay. Well, say I was long Apple and I want to have a stop. So if we trade below the low of the day here, I want to get out. Well, we could gap down in the stock and open. If we could open several dollars higher or lower, $5 lower, and if you have an order there, it can actually jump around that, and as soon as that market opens, it's going to fill you at that price. So immediate loss. Whereas futures, because they trade throughout the evening, they allow you the opportunity to have orders that if the market just starts, if it gets goes lower, it's just going to come and get your order overnight. So it allows you to mitigate risk that you can't as easily mitigate in the equity markets. I really like this. I like sleeping knowing that I can have a position on and I have orders working that'll take me out if something adverse happens. Final benefit is the tax benefit. So in the stock world, if you're doing positions, you have to account for every single position on your taxes. It's tedious. It's not a lot of fun. On the future side, you get a 1099 at the end of the year, and you can submit that as part of your taxes. You don't have to list every trade, and that's a really, really cool benefit. Risks to the products, just as it's a benefit, the leverage is also a risk, because what happens is if you get in a position that goes against you, and it's greater than the margin, the loss is greater than the margin that you put up, you actually have to add additional capital into the position to just hold the position. And if the loss is greater than the cash that you can put in, you actually end up owing the broker money. Not a position you want to be in. This is what we call a margin call. I've experienced one of these. It is no fun. So know that this is a risk. Also know that one of the risks around futures is they expire. So, you know, on a stock, if I buy a stock, I own that stock come hell or high water, unless the company goes out of business or something adverse happens. And the most that I'll lose is whatever I paid for the shares. You know, so like that Apple, if I had one share Apple at 174, I'm out 174 bucks. Okay. With futures, they expire. These contracts have multiple contracts that can trade at a certain period of time, and they expire over a period of time. So just to give you an idea of what that looks like, let's go over here. We're going to pull up. We're going to look at S&P 500 futures. We're going to look at all of the active months. Okay, you can see that right now there are 5 contracts that are open. So this is a March contract. It expires in 67 days, all the way down to March of 2019. So you actually trade a position for March 2019. That's 431 days. So 67 days from now, this contract is no longer tradable. It'll settle in cash. So in order to hold a position, you have to roll that position into the next month. Different futures expire in different increments. So that's something to be aware of. They don't all have the same expiration cycle. So some will expire every month. Some expire quarterly. So you just kind of have to know where you're in to make sure that you're in the right month. I trade crude oil a lot. If you look at crude oil, you will see that it has an expiration every month. So February, March, April, May, June. Okay, so Feb is the active month. We've got 14 more days, and then we'll start trading March. Now we'll actually start trading March before February goes off the board. We actually just watch the volume of the contracts, and once the next month has contract volume that's higher than the current, or what we call the front month, so the first month, that's the front month. Once this volume exceeds, then we rotate to the next expiration. And that makes sure that we're in the right. And sometimes there are funky ones where you have products, especially around grains, where you actually have volume that is in months beyond the front month. So you can see here there's a Jan contract. It's actually going into delivery right now, but the March contract is where all of the volume is. Or if I look at live cattle, you can see that we're just about to start making the turn from February to April. So that's a fun quirky thing, but they do expire. You don't want to be left in one, or then you're going to lose everything. You're going to lose all that cash. Last risk around futures is the startup costs. So initiating a position, like if I wanted to buy 1 share of Apple stock, I could buy it for $1 or $174. There are stocks that trade for, well, there's penny stocks, right? That I can buy a share for 30 cents or something like that. Okay. Futures, because they are an institutional instrument and they are where professionals participate, are more expensive. So to initiate a position, you have to have different margin requirements. So if I click over here and look at the different products, for example, if I want to put on 1 contract of gold, I need $4,400 in initial margin. So you're likely going to want to have way more in your account than the actual margin, because if the product goes against you, then you're actually immediately on call. You're going to have to owe the broker money to keep the position on. And you can see that different products have different margin requirements. Some as little as 165 bucks. Some of them are 4,400. We have Bitcoin futures that are on the markets just of late, and those are $40,000 to put on one, because the margin is set based on the perceived volatility of the instrument, which, I'm not going to dive into that a lot, but the margin's those fluctuate based on how much the exchanges believe that product is going to move. And the wider that is, or the more that it's unknown, if it's a new product on the exchange, they'll make that margin pretty hefty. So startup costs can be prohibitive, especially if you're a brand new trader and you have a really small, what we call a micro account, which would be under $10,000. Okay, so let's talk about selecting futures products, because there are a bunch of them out there in the futures complex, and want to just talk about it in terms of asset classes. So one, there's indices or index futures. A few of the popular index futures are the ES, the YM, and the NQ. These are the ticker symbols. This is the S&P 500, the Dow, or the NASDAQ. In treasuries, we can trade interest rates. So this is the 30-year US bond, the 10-year treasury note. We have currencies. These are just a couple of the popular ones. We can trade the euro or the US dollar. Energy, there's crude oil or natural gas. In meats, there's live cattle or lean hogs that you can trade. In the grains, we have corn, soybeans, wheat. Metals, we have gold, silver, copper, and then others that we call softs, which are like coffee, orange juice, cotton. And there are many, many more products that are out there available. These are just some that are the most popular and have the greatest number of contracts traded per day. So I like a future. These softs are very illiquid in terms of futures products. They don't have a lot of contracts traded. Now, if you're trading one or two, no problem. If you want to trade 100, you might be in a little bit more problem. If you're trading stuff like the meats or silver, copper, but most of these here on the left are very liquid, and there's lots of participation and really good products to have on your radar. I trade a lot of NASDAQ, the 30-year, crude oil, and soybeans are kind of my four that I'm looking for an opportunity in every day. Finding opportunities. Well, there's a couple ways that people look for opportunities when they trade futures, and because it's tied to a physical commodity, and because of these expiration cycles, there's something called convergence, where you have the future price that converges with the cash price at a certain point in the future. So you find a lot of futures traders who think about fundamentals, and they read inventory reports and they look at economic reports to get an idea of where that thing's going. Some also, to think about their risk, they will pair or spread the markets, meaning that they will simultaneously buy 1 month of the product and sell the other. So, like I look over here at this live cattle, you could actually buy April and sell June against it as a way to initiate a position. One of the reasons people do that is because there's a little bit of a spread between those prices. You can see here there's about a $8 spread between these prices, and that spread is not as wide as just the actual instrument. It's a way to, you're really trading the distance between the 2 months rather than trading a direction. That's the way people trade. Some spend hours researching, to which we say, nah, we make it a little bit simpler. I don't trade on fundamentals. I don't pair or spread. I just look for markets that are balanced and preparing for a move, or that are away from balance and looking to fade or return to balance. We call this a mean reversion trade. And when I'm looking for opportunities, I'm incorporating the auction, open and day types, and behavior statistics. So, if I look at how the market opens and how that initial balance opens, it can predict what type of day I might see. And then I'll look at behavior statistics like the average trading range and say, okay, well, crude oil has traded 25 cents so far in the session. Its average is $1.20. Oh, wow, there's possibly another dollar left of range in the session. So if I position myself appropriately, I could capture a good bit of that. So these are how we find opportunities in these products. Okay, so just to give an idea of what it can look like when you trade futures, I'll look at a more realistic example of finding opportunities in futures. Here's a market profile and volume profile chart of S&P 500 E-mini futures. This is right before the market's about to open. So this is actually showing you what we call the Globex, the overnight trade. This is yesterday's session. This is it overnight before that, and then the prior session. So, one of the things that I would look for in terms of a return to value, look at the prior day's points of control. Have those been traded across? Often we'll trade across those levels. You can see we have not traded across this one. We've not traded across this one. So I would be looking, especially on this session, to see an early move back toward this prior day's point of control. So if we're trading at 26.66 and the point of control here is at 26.60, if I'm looking for that to be tested in the session, it's about 6 points. Each point in the S&P 500 is $50 because it's $12.50 per tick, and so 6 times 50 is about $300 on one contract, which is not a bad day. You string a bunch of those together, and you can make $65,000 in a year pretty easy. It's never that easy, by the way, but that's one of the ways that you identify opportunities. Is you look at where you are in the overall market. We can see that we've been moving higher, and we're not doing as much volume as we move higher. So here you have an auction going higher. It's not getting as much participation. We have a little bit higher prices in the Globex, so I'm not expecting this thing to fall out of bed, but I do have a reference from yesterday, prior session that's not been tested, and that would be something that we would test. So just to give you an idea of what this can look like, so let's just play and see how this session actually played out. So you can actually see how these profiles look when they start trading and developing. Okay, so now we're into the real-time session. Have a new profile from the open. It's now trading back to test that level. See if it can get all the way down there. So here it's starting a B period, it's flirting around the open. If it's going to go get that level down there at 26.60, it needs to happen pretty soon here. Otherwise, we run the risk of auctioning higher. So I would do this. I'd kind of look around, have the expectation that it would move lower. If it can't stay below the open and gets acceptance back above that, then I would take that trade off, which right now it's not looking real great. I would want to see that happen pretty quickly, that move would come all the way down to test that. And doesn't look like it's happened. So that would be a trade that you would take off and you look for a different entry. But that's the general idea, is that you're looking for moves like this and identifying untested levels and looking for, in some sense, reversion back to them is the way the trade goes. I don't remember this day. I don't often trade the S&Ps, which is why it's a good one to look at as an example. But that's also how the graphic can look as you are trading these 30-minute periods. It's just trading back and forth and building this graphic. And the shape of the graphic helps you understand the day types and the open types and the expectation for what that day would look like. So here you have range extension to the upside above the initial balance. And from an open standpoint, we have an open auction outside of range, meaning that the B and A period are overlapping above the high from the prior day. So this could actually now move significantly higher. You would be wrong if you went below the A period low. Okay, where can you learn more about futures and trading them? One place to go is to investopedia.com. You can read about the products, learn more of the nomenclature and jargon. That can be really helpful in helping you understand how these products work. The CME, which is the Chicago Mercantile Exchange, that is a wealth of information on specific contract specs, the hours these products trade, what the volume is looking at, on them. Investing.com also has a very robust futures area where you can actually see live real-time quotes, and you can actually practice by establishing positions and see how they auction, which I highly encourage you to do. Create a mock portfolio, add some futures positions in there, and just get a sense for how they move from a P&L standpoint. Stick with tradewithprofile.com. We spend most of our focus on futures. So our day trade plan, our swing trade plan, and our profile development pathway, we use futures as the example. Again, because profiling was birthed in the futures market, and that's where the pros come to play. Even those who are in big funds in the equity space are also active in futures as a way to hedge their portfolios. If you're looking for a brokerage, so to be able to trade futures, you need a brokerage that can actually do that, or you can transfer money into a brokerage account and trade. The one that we recommend is stage5trading.com. That is they're profiling traders. They have really good commission rates, good guys. So if you're looking for a place to practice, they have demos that you can demo their brokerages and also get a live account. Stage 5 is a place to go. Or TD Ameritrade is another brokerage. Don't have a relationship with TD Ameritrade, but I've had a TD account for years, and I really like their mobile apps and as an augment to the rest of my trading system. Okay, homework. Follow popular U.S. products. So whether you want to create a watch list on investing.com or some other platform, but just follow the ES, which is the S&P 500, the CL crude oil, GC gold, ZB the 30-year bonds, ZS is soybeans, and 6E is euro. That'll give you a view of a lot of the popular products that are traded. Look for opportunities on the largest time frame. So again, going back to the modules we talked about, price action, looking for the price reversals or price continuation pullbacks as ways to identify just the price action. And then, if you have profiling tools, being able to look and see where you are relative to the higher volume to get a sense of whether you're looking to go back towards value or to move from an area of balance. Answer the 4 questions from Module 3 when looking for a position to get in. Set alerts. I use alerts a lot to keep me from being active when I don't need to be. Like if there's a behavior that I'm looking for, I use alerts to alert me to it so I can go do other things. Trigger on daytime behavior. So once you've kind of come up with a plan of where you're interested in playing or prices that you're interested in being active in, have those alerts trigger and then look for triggers based on the behavior in that session and practice it 100 times. We cannot overstate the necessity of practice and reflection on the results of that practice as a way to understand progression and performance. If you do just a few trades and don't have a way to discern whether that was working or not working, you're really certainly no place to put any live money on the line, and you really have no edge. So practice, stay focused, pick one product or 2 products, just like we have here. Look for a specific type of pattern or behavior in the auction, trade that over and over and over and over and over again, and that's going to teach you a whole lot and lead you to the next level. Next steps: review this video, complete the homework, proceed to the next module. As always, if you need help, shoot me an email, give us a call. We're here to help and help you progress. Check out futures. We think they're awesome. We think you're going to enjoy them, and we'll see you in the next module.